Looking for low-risk, high-reward trades? Then you must master support and resistance. It's a foundational skill every successful trader relies on. In this video, I'll show you how to draw support and resistance levels the right way, just like professional traders do. Not the usual horizontal lines that often fail, but precise zones that price actually respects and reacts to. And if you're a beginner still dragging one line across the chart, don't worry, I've got you. I'll share a powerful tool that can automatically plot perfect support and resistance levels on your chart with just one click. And yes, if you've ever wondered how to actually trade around those levels, we'll touch on that too. So don't skip this, or you might miss the one tool that could completely shift your trading edge. Let's get started.
Support and resistance are key levels on the chart where price reacts due to buying and selling pressure. Support is the zone where buyers are likely to step in. It acts like a floor holding the price. Resistance, on the other hand, is the zone where sellers dominate. It acts like a ceiling pushing the price down. If you enter near a key support or resistance zone, instead of picking random levels or weak setups, you significantly increase your chances of getting a strong risk-to-reward ratio, along with a higher probability of winning the trade. But to trade effectively, you need to know how to draw support and resistance zones properly. The truth is, most traders, especially beginners, draw too many lines on the chart. That's wrong. Avoid that. Too many lines make your chart more confusing, and when it's time to enter a trade, it doesn't improve your analysis. It makes it messy. Support and resistance should give you clarity, not confusion. Let me show you a mistake that most beginner traders make. Right here, the market breaks a resistance level, and instantly, many retail traders jump in for a buy. It looks like a breakout. It feels like a breakout, but just a few minutes later, price reverses sharply and hits their stop loss. Why does this happen? Because they traded off a weak level. Let's take another example. Again, you can see the market broke its resistance. Beginners enter the trade, expecting the price to move straight to their target, but instead, it stalls and then reverses. Stop loss. Gone. This is the danger of trading random levels. Just because a level looks clean doesn't mean it's strong. Strong support and resistance zones have history. They've been tested multiple times. So how do we identify strong levels and avoid getting trapped? Follow these rules. Step number 1, multiple rejections. Identify zones with multiple rejections. Let me show you exactly what I mean on the chart. You'll notice the price comes down, touches this level, and bounces back up. Then, after some time, it returns to the same level, and once again, it bounces. That's not a coincidence. When the market reacts to a zone multiple times like this, it means one thing. Buyers are stepping in again and again to defend this level. This is what we call a strong support zone, because the price is being rejected from the same area over and over. And the next time price comes back to this level, there's a high probability it will reverse again. Now take a look at this chart. I've drawn a simple horizontal line here, but if you notice closely, the price isn't bouncing off that exact line. Instead, it's reacting somewhere around it, sometimes a little above, sometimes just below. But here's where most beginners go wrong. They draw just one single horizontal line and expect the price to respect it perfectly. But what happens? The market slightly overshoots that line, and suddenly they panic. Why? Because they're not identifying the actual area where the market reacts. Let me make this clear. Support and resistance is not a single line. It's an area, a zone where buyers or sellers are likely to take action. So instead of using just a line, you should draw a complete zone like this. To do this, simply use the rectangle tool on TradingView. You'll find it on the left-hand toolbar. Scroll down a bit and look for the icon that looks like a square. Click it, then drag to mark the entire area. This gives you a much clearer and more accurate level to watch for price reactions. And trust me, this one small change can significantly improve your trade setups, entries, and exits. Now looking at a chart like this, there aren't any multiple rejections yet. So, how do you draw support and resistance here? That brings us to step number 2. Use key swing highs and swing lows. You can see that the price dropped down to this level, and from here, it bounced back up. This area where price reversed is what we call a swing low, and this is a key place where buyers stepped in. So what I'll do is mark this zone as a potential support area. Now let's flip it. Look here, the price moves up, reaches this peak, and then drops back down sharply. That's your swing high, and it shows you where sellers dominated. So I'll mark this as a resistance zone. So to keep it simple, swing lows mark as support, swing highs equals mark as resistance, and always draw them as zones, not thin lines. Now let's move on to step number 3. Support becomes resistance, and resistance becomes support. Let me show you exactly what I mean. Look at this chart. You can see here, the price was falling, then it hits this zone and bounces back up. That was acting as a support level. But here's the interesting part. Later, when the price comes back to the same level, it doesn't bounce again. This time, it gets rejected from the bottom side and starts falling again. That same support zone has now turned into resistance. In this part of the chart, price was rising and got rejected at a resistance zone. But once it breaks above that zone and comes back down to retest, it bounces from that same level. This means the old resistance has now become support, and every time this flip happens, it creates a high probability zone for your next trade, so the next time price breaks through a major level, don't rush your trade. Wait for the retest. That's where smart traders look for confirmations and better entries. Now finally, step number 4, always consider the current price context. Most beginners make the mistake of drawing too many support and resistance levels, even if price is nowhere near them. That's not helpful. It just clutters your chart and makes analysis harder. So here's the smart approach. Focus only on the levels that are relevant to the current market price. If the market is trading near a key level, that's where your attention should be. For example, if the price is approaching a recent swing high or a demand zone where multiple rejections happened earlier, that's your zone of interest. But if the price is far away from that area, there's no need to clutter your screen with unnecessary lines. This way, your chart stays clean and your decisions stay focused. Let's apply this live on the chart. You'll see I'm only drawing levels near where price is currently trading, not every historical bounce. Remember, support and resistance zones are there to help you, not confuse you. As I promised earlier in the video, I told you I'd share a powerful tool that can automatically draw support and resistance levels on your chart with just a single click. So here it is. This tool is called the Pivot Point Standard Indicator. And trust me, whether you're a trader still refining your levels or just looking to speed up your analysis, this indicator can save you time and give you quick structure on your charts. Here's how to add it inside TradingView. 1, click on Indicators at the top of your TradingView chart. Search for Pivot Point Standard in the list. Select the one created by TradingView, and that's it. The tool will instantly plot multiple dynamic support and resistance levels for you based on recent price movement. But remember, don't rely on it blindly. Use these levels along with the price action concepts and drawing techniques. So finally, how do you actually trade support and resistance? You've learned how to draw these zones properly. Now it's time to make them work for you. On this chart, you can see the market is moving sideways, a clear ranging condition. Price is bouncing between the support and resistance zones. So what's the best way to trade it? You wait for price to return to a zone and give you a retest. But here's where most beginners go wrong. They jump in the moment price touches the zone. That's risky. What you need is confirmation. Maybe it's a rejection wick, a bullish or bearish engulfing candle, or simply the failure of the price to close beyond the level. Once you've got confirmation, enter the trade. Set your stop loss just below the zone and target the opposite side of the range. This is how you trade smart, not emotionally, not randomly. Let the market come to your level, prove its intention, and then take the trade. And trust me, once you start combining these zones with strong confirmations, your win rate and confidence will go up. If you want to take this one step further, I'll soon be uploading a video on how to combine these zones with trend lines, indicators, and price action for even more accurate entries. So make sure to subscribe and turn on notifications. So, if you draw support and resistance zones properly, you won't just find better entries and exits. You'll also be able to predict where the market might go next. It helps you identify the next target and even plan your trade several steps ahead. So don't underestimate it. This skill can give you a serious edge in the market. If this video gave you clarity and confidence, don't forget to like, subscribe, and turn on the bell so you don't miss the next advanced breakdown. See you in the next video.